So our core view is that the commercial real estate cycle has moved into recovery stage. So let me just unpack what that means. Listed REITs trough first. Listed REITs troughed in October of 2023. They were up 45% from that trough, having a great start to 2026. Private valuations trough second. They have now risen for 6 consecutive quarters in the United States, but debt is a lagging indicator. The headlines are going to get worse before they get better. Rising distress in the debt markets is part of the grieving process. It's the acceptance stage of the grieving process. So we think this cycle is...
Do you guys send flowers to each other when someone tanks?
So it is part of the grieving process. But this cycle has turned the corner. We are in the very early stages of a recovery. Most people, when you talk about the recovery in commercial real estate, they believe it lasts 10 years. We actually believe it lasts much longer, closer to 20 years. And a lot of that's because of the underappreciated value of income. Commercial real estate is sort of a boring asset class. That's been out of favor for the past several years, but income is beginning to kick back in.
What are the sectors within commercial real estate that you guys like at the moment?
Yeah, sure. So when we talk about this recovery, we don't think it's going to be a V-shaped recovery. The headline might look like it's a U-shaped recovery, but it's actually a K-shaped recovery, just like what's happening in the U.S. economy right now. So there's wide dispersion between property types, markets, and even fund vehicles. What do we like? We continue to lead into our data center thesis. Data centers, believe it or not, in the public markets are up almost 25% this year, even as other AI stocks are getting hit. We really like senior housing. We like parts of the housing market. And I would even say open air shopping centers. So they're really resilient asset classes, things that we think can do well regardless of what happens to the economy.
Is an open air shopping center like the Great Barrington Market on the weekends?
Maybe.
Buying bushels
You don't
of
have
apples?
them on the Upper East Side, I don't think.
Yeah.
Yeah, I don't think you have them. But yeah, those are big.
Real simple. It's a grocery store anchored open air shopping center, or it's something anchored by a Lowe's or a Home
So
Depot.
you want to buy Wegmans?
We
You're
did.
long Wegmans. Okay. Paul Sweet.
So, I mean, talk to us about just on the residential side in the sense that we have a housing shortage in this country. I'm not sure how we got there, but people keep telling me we have a housing shortage. What's the solution to that generally?
Yeah, sure. So let's back up and talk about this housing shortage for a second. There's a great statistic out there that's thrown around by almost everyone that we're underhoused by 5, 6, 8 million homes. Pick your number. We actually push back on that thesis a little bit. It is mathematically true, but it's actually the wrong debate. We think we have a housing mismatch in the United States. We've built too many houses of certain types in some markets and not enough houses in other types in other markets. We actually might have an oversupply of conventional Class A apartments in high growth markets like the Sun Belt. And we don't have enough housing, affordable housing or resilient housing, Class B housing. So the way we got here, and I'll pause here in a second, is we just didn't build enough relative to the population. But what's going to happen over the next 10 years is really fascinating because the U.S. population ex-immigration is going to start to go negative. So we think that you have to be a lot more careful about where you're building housing.
Rich Hill with his global head of real estate strategy and research at Principal Asset Management, massive research chops in the transactions of real estate, going back to a small shop named Morgan Stanley. Okay, help me with private credit. Sweeney was gone. He was on the slopes with all the private equity guys while private credit's blowing up. What's the linkage of your world of real estate and CRE into private credit? Are you up to your eyeballs in mezzanine trouble?
So we have been up to our eyeballs in mezzanine trouble over the past 2 to 3 years. This whole distress that we've seen in the CRE debt markets, that's what we've been dealing with for the past 2 to 3 years. We haven't been, while the private credit and private equity markets haven't been dealing with that, commercial real estate has been. I actually think some of these headwinds that we're beginning to see in private credit are maybe the best thing that we've seen, that we've had happen to the private commercial real estate credit market in a long time. Because private commercial real estate credit, it wasn't the exception. It was just a leading indicator. So what we see happening now is private CRE credit is starting to get a lot more attention from investors because the returns are just super, super stable. You can put up 8 to 10% returns in private CRE credit. You've already been through the downturn. You're underwriting on valuations that have already declined.
So, okay, translate what he just said, Paul. The whole basis of private credit is I want to pick up 200 basis points over everything else?
And yeah,
is that basically the pitch?
That's what we've heard before. And this,
okay.
What I think we're hearing from Richard, this is an asset class that can support it. Rich, before we let you go, I want to really get a sense of, because we're here in New York City, a lot of our listeners are in big urban markets as well. Office. Talk to us about where we are in the world of office real estate.
Sure. So office is facing some challenges right now, not just because of work from home, but it's had new AI challenges. So if you think you're going to have a white collar increase in unemployment, then some sectors of the office market could be hit. And office REITs have been under pressure because of that. But we think this is a very bifurcated housing office market that's beginning to occur. 90% of office vacancy is concentrated in 30% of buildings in the United States. 40% of buildings have no vacancy whatsoever. So the market's just trying to figure out what's a really good building and what's a not so good building.
So what do you do with the B and C inventory?
What do you do with the 7 buildings that Paul and I look at every day?
Exactly.
Paul gets in the Bentley out on Lexington Avenue, and as you go 180 degrees, 5 of the buildings are under.
Yeah. So the really short answer that takes a lot longer to explain is that we actually have to reinvent all of this stuff. And it has to be public and private partnerships. But could you imagine if the public and private in New York City could get together and just think about how to reinvent this broad sense of building?
Let's solve this right now. I mean, it's only a Monday. Alexis, help us out here. The ugly building on the corner of Lexington and 57th, they're putting the Place Vendôme scaffolding up right now. How many apartments can that building hold? Why can't we do this?
So I think it's a combination of both. I was in Zurich 2 weeks ago, and someone pitched me a really interesting idea that the top floor of all these old office buildings should just become new logistics facilities for drones as we start to ship things in minutes. I think that's a really interesting idea. So the top stories will be logistics. The second stories will be apartments. Maybe you'll still have a little bit of office, and then you put some retail underneath. You have to think about these things really creatively, but these office buildings are becoming cheap enough and have an attractive enough basis where maybe you could be incentivized to actually redevelop these.
Has there been any blowups here in, just say, New York City, where an office building is traded at 50 cents on the dollar and the creditors have to take the hit?
Oh, of course.
Okay.
And those headlines are going to continue to play out because guess what? Banks do not like to resolve distressed loans into a distressed market. They like to resolve distressed loans into a stabilized market. Borrowers do not return the keys to the lender until they recognize the past is not coming back. But that's all healthy. We are now beginning to clear.
I got 12 seconds. We're at the point where a really ultra fancy place in the Hamptons costs more than a decent B-class property in Midtown Manhattan, right?
Yes. Yes.
I mean, the kind of place Sweeney would live in the Hamptons.
But that's a huge opportunity. Finally, commercial real estate is back to a level where if you have long-term capital, so sovereign wealth funds, ultra high net worth families, they're actually looking at the commercial real estate market for the first time in a long time.